Welcome to the Explainer. I am so incredibly excited to get into our topic today because we're looking at something that is literally powering our future, but also, let's be real, deeply affecting all of our wallets. We're talking about the massive transition to green energy. Today, we're doing a deep dive into MGE Energy. This is a utility company that finds itself at a totally fascinating but really challenging crossroads right now. We're going to open up their financials, look closely at their plans for the future, and really examine the very real tensions that their green ambitions are creating. Okay, let's dive right into this. So, what is the true cost of going green? Look, we all know that transitioning away from fossil fuels is just a monumental task. But it's not just some engineering puzzle, right? It is a massive financial balancing act. Think about it. How does a regional utility company effectively fund billion-dollar clean energy investments while keeping their Wall Street shareholders happy? And, at the exact same time, keeping everyday consumer power bills actually affordable? Honestly, it's quite the tightrope to walk. $1.9 billion. Let that number sink in for a second. That is the sheer scale of the ambition we are talking about here. It's MGE's projected capital investment over just the next 5 years alone. They're pouring all this money into wind farms, solar fields, massive battery storage solutions, and even some natural gas generation just to make sure the grid stays perfectly reliable while they transition. It is an absolutely breathtaking financial commitment. All right, moving into Section 1, the bull case, strong earnings and dividends. So why are investors looking at MGE Energy right now and feeling so optimistic? Well, just look at the sheer earnings momentum they've been generating. Their first quarter net income jumped from $41.5 million in 2025 all the way up to $48.5 million in 2026. That is an extremely impressive 11.2% earnings growth right out of the gate over the past year. In the regulated utility space, where, steady but slow growth is usually the norm, a jump like that definitely turns heads on Wall Street. And they aren't just growing their top-line revenue either. They're operating incredibly efficiently. Their net profit margin is sitting at a very healthy 19%, and that's driven by trailing 12-month revenues of over $750 million. For a regulated utility that has these massive capital-intensive operations, holding a near 20% margin, that shows a really steady, predictable, and highly efficient profit engine. Now, if you are an income-seeking investor, this is practically a dream scenario. Analysts actually refer to MGE as a dividend fortress, and for good reason. They boast 51 consecutive years of dividend growth. Think about that. Over half a century of increasing payouts without fail. They currently offer a 2.5% dividend yield, which works out to an annual payout of $1.90 per share. For value-oriented investors who prioritize consistency over, say, fast, unpredictable textile growth, it's an incredibly attractive track record. Which brings us to Section 2, the bear case. Is the stock overvalued? Now, as with any financial analysis, we have to look at the whole board, right? Despite all that great earnings momentum we just saw, MGE's share price has actually seen some recent softness. It dropped about 4% over a recent 30-day period. So to really get where the bears are coming from, we kind of need to look at the PE, or price-to-earnings ratio. It's basically a quick way to ask exactly how much are investors paying today for just one single dollar of a company's profit. If that number is high, well, either people are expecting crazy future growth or the stock is just getting a bit too expensive. Okay, let's dive into this valuation clash. MGE's current PE sits at 20.9 times earnings. However, quantitative models suggest its estimated fair PE should actually be quite a bit lower, right around 18.5 times. So while 20.9 is roughly in line with the broader utility industry, the fact that it's sitting above that 18.5 fair estimate suggests the stock is currently trading at a premium. Basically, the market isn't giving you any kind of discount right now. And wow, this gap gets even more obvious when we use a discounted cash flow model. Now, that's just a fancy way of forecasting a company's actual future cash flows and figuring out what they are worth today. Right now, the share price is trading around $74.39, but the estimated fair value based on those long-term cash flows, it's only $61.50. That is a massive difference of nearly $13. So the absolutely crucial point the bears are making here comes down to leverage and coverage. MGE has high debt levels. Now, that isn't totally unusual for a utility building expensive infrastructure, but that really attractive 2.5% dividend yield we talked about, it's actually not well covered by the company's free cash flow. if market sentiment cools down even a little, or if the costs of those green investments run higher than expected, that lack of cash flow coverage leaves very little room for error. Let's look at Section 3, the consumer clash, Wall Street versus Main Street. Let's expand our view a bit from Wall Street metrics to the real-world impact, because at the end of the day, somebody has to foot the bill for that $1.9 billion in green investments. On one side, MGE is saying, hey, we urgently need funds through rate increases to pay for this clean energy transition, vital system upgrades, and to cover some recent project cost overruns. But on the other side, you have the Citizens Utility Board of Wisconsin waving a massive red flag. They're pointing out that MGE made $120 million in profit in 2024 alone. The board argues that profit is already excessive, and everyday consumers absolutely shouldn't have to shoulder the burden of higher rates while the utility is already raking in that much cash. So, what does that burden actually look like for the average person? Well, MGE is proposing some really steep electric rate increases for its customers over the next 2 years. We're talking a 4.9% hike in 2026, followed by another 4.3% hike in 2027. In total, they're asking for a $47.7 million increase over just 2 years. And get this, it's not just the energy rates. They're also proposing to raise the fixed monthly customer charge by $1 each year. That is a direct, completely unavoidable hit to consumer wallets. And to make matters even more controversial, there's a specific percentage driving this whole debate, 10%. As part of their application for these rate hikes, MGE is proposing to raise its guaranteed profit rate, which is known in the industry as return on equity, from 9.7% up to an even 10%. Consumer advocates are just heavily criticizing this request. They argue that the current 9.7% is already higher than the national average, and it's more than enough to attract the Wall Street capital MGE needs, without asking regular consumers to pad those margins even further. Finally, Section 4, inside the boardroom, a balancing act. So how on earth does the leadership of a company navigate this kind of incredible tension? Because they are caught right in the middle. Let's look at how their executive compensation is structured to try and force a balance. The CEO, for example, received roughly $3.6 million in total compensation in 2025. But look at the actual metrics that pay is tied to. Yes, of course, it's tied to hard financial success, like earnings per share, return on equity, and total shareholder return. But crucially, it is equally tied to public-facing metrics, like customer satisfaction ratings and system reliability. The board is literally paying its executives to solve this giant puzzle, figure out how to satisfy Wall Street investors without totally alienating their Main Street customers. Which leaves us with this final, honestly provocative question. Is MGE Energy a green pioneer, making the really tough, really expensive, but absolutely necessary choices to upgrade our grid for the future? Or are they an overvalued utility that is placing way too much of its financial burden on everyday consumers just to guarantee shareholder returns? It is such a fascinating tension between funding our green future, rewarding the investors who actually make it possible, and, keeping the lights on affordably for everyone else. Think about how your own local utility might be facing these exact same challenges right now. Thank you so much for joining me for this explainer. I really hope it sparks some great thoughts, and I'll see you in the next one.